Hi class, this lecture is for the Hudson County Community College Microeconomics class. Today is April 5th, 2022, and we have class on April 7th, 2022. However, on the 6th, unexpectedly, I have to get surgery. So according to my surgeon, like I'll be down, for like a week, but I'll be back next week. I'm down, but I'm not out. So, but I'm instead of notifying Ilana and Ara and having a substitute, of course I'm gonna notify Ilana and Ara what I'm doing. But for the sake of continuity in terms of the material and your familiarity with me in terms of how I present the information, which you've been accustomed to all semester, given the fact that I can't be there physically, I'm going to utilize YouTube lectures, which I have found. If there's one thing I can say during the shutdown, I found these to be a very useful and effective tool for getting material out to students. Now, the way this works is that we break the lecture into two parts. The first part runs roughly 1 hour and 20 minutes. The second part runs roughly 1 hour and 20 minutes. Now, for the purpose of attendance, what I do is I embed in each lecture, part 1 and part 2, an attendance code. Now, for the people who view the lectures, they're going to get access to the attendance code because I'm going to bring it to your attention. The way you basically mark yourself in is to either send me an email in my Hudson County account and indicate to me what the attendance code was in lecture 1 and in lecture part 2. There'll be two, one for part 1 and one for part 2. And that's how I take attendance. Now, if I don't hear from you, what will happen, of course, is that, you're going to be marked, you're going to be marked absent for that day. Everybody's going to be notified. Like what I'm doing now is I'm just getting these lectures together and getting them uploaded onto YouTube. And then later today, I'm notifying all of my students, I'm directing them to my YouTube channel for the purposes of this week in terms of the lecture. When we get back, we'll probably because we're still in chapter 8, corporate governance, and yeah, we're still in chapter 8 today. But when we get back, what I'm going to do, and I did mention this to a few people before break, is that we're going to view The Big Short, which there's many lessons to be learned in terms of corporate governance and the nexus, or I should say the effectiveness of the nexus between businesses and regulatory agencies that oversee them. And also, needless to say, the potential for regulatory capture, which we will go over in the second part of this lecture. The first part, I just want to kind of recap and revisit some of the basics that we more or less surveyed um, before the break. And again, I apologize for having to do this. I don't miss class. Um, 12 years of teaching, you know, this week, my obligations on Wednesday, Thursday, and Friday, I'm missing 3 classes. It's the first time in 12 years that this has happened. And I apologize for not being present and having to resort to this modality. Although you may find that this is rather convenient because you can listen to it if you want to at 2 or 3 o'clock in the morning if that suits you. Um, don't be afraid to reach out to me. I'm going to be home this week and this weekend. If you have any questions about the material, you can email me. You can telephone me. You've got or you can text me, and I will definitely get back to you. Just in case you do have questions. Again, you're not bothering me. I'm here. You know, consider this to be very close to a live class. The only difference is that you would probably complete the lecture, and then if you have a question, call me for clarification. That's the only difference. Now, what we were looking at I shouldn't say last week, but the week before last, before we went on break, we were looking at firms and looking at the formation of firms in terms of the different choices, the different modalities of doing business. Sole proprietorships they're a large chunk of businesses. And there is, in many respects, what you do find is a lot of times um, sole proprietorships basically operate in a pure perfect competition market. So there is a turnover. There's a lot of ingress and there's a lot of egress, um, you know, of sole proprietorships into into the market. Um, the risks, of course, is that a sole proprietor is in terms of liability um, is personally responsible. From a tax perspective, the sole proprietor is taxed at their own individual rate. They would use Schedule C. A partnership, if you look at a general partnership, what you want to really look at in terms of how the partnership is arranged is you would want to look at the partnership agreement or sometimes known as the articles of partnership. And this basically spells out the duties and the rights and the responsibilities of the general partners. It also spells out compensation. Compensation doesn't necessarily, like when we say partnership, we're talking about two or more people or two or more sometimes entities um, that do business together. So don't ever assume that there's an equal sharing in profits. You always have to look to the partnership agreement. Another thing you always have to consider in formulating a partnership agreement is having a clause in the articles of partnership, a right of first refusal, meaning if in the event one of the partners, general partners, is leaving the partnership and wants to sell their partnership share, they have to approach the other general partners and offer, their share first to the general partners that are remaining. And the reason being that that's important, that doesn't happen, automatically. You have to have that clause in there. And what's important about that is you don't want to be in a position where, you have one of the general partners leaving and they ultimately sell their partnership share to Jack the Ripper or Vladimir Putin. You don't, you know, you may not, want to be in that type of business arrangement with certain people. So partnerships are, they're usually not arm's length. They begin with people that know each other fairly well and get together, and it's kind of like marriage in a way. There's a honeymoon period, and then after the honeymoon, things can happen. But you want to prepare for that event in terms of a general partner wanting to leave the partnership. Um, a limited partnership, I mean, for all intents and purposes, it's really an investment vehicle. I mean, years ago, the nomenclature that was used to describe a limited partnership was silent partner. And the reason they called it a silent partner was that that partner doesn't engage in any of the managerial prerogatives that are exercised by the general partners, or or in any form whatsoever, because a lot of times those managerial prerogatives are divided kind of uniquely. Sometimes there's a managing partner as opposed to everybody exercising unilaterally their managerial prerogative. But putting that aside, the silent partner, the limited partnership, really basically brings financial capital or some type of equity to the partnership, and basically is interested in receiving an articulated return on investment. So limited partnerships, for the most part, are investment vehicles. Partnerships, once again, are pass-through entities for tax purposes. For tax purposes, they're passed through, meaning the partnership will report to the Internal Revenue Service on an informational return certain cri- certain information criteria that's set forth, profits and losses and so forth. I mean, the utilization of a financial statement and a balance sheet would be utilized by the accountant that's putting together the informational return. And then the profits and losses are shared in accordance with the articles of partnership, and that's reflected on your individual returns. So once again, it's individual rates. You're not paying, the corporate rate. Corporations are said, and we'll go over this, a little bit more at length, are said to be, taxed twice. You have the taxation of corporate profits, and then when there are dividend disbursements, or there are salaries paid, or there are, different compensation vehicles, whether it be profit sharing or whether it would be bonuses, whatever it may be, it's taxed again. But first, there's that one layer of corporate taxation. Most businesses in the United States, in terms of the volume of businesses, are pass-through businesses, where it's the corporate rate is not applicable. What happens is the pass-through vehicle sends information to the IRS, and as a result, um, the partners pay at their own individual rates. Now, keep in mind, depending upon the financial, nuances of each partner, one partner may be paying, in terms of the top marginal rate, may be paying considerably a different tax rate than some of the other partners. In terms of limited liability, once again, partners are basically vulnerable to what we call joint and several liability. Joint and several liability means the defendant or the creditor, whoever it may be that's suing you, can basically target the partner or partners that are asseted. Meaning, if they do an asset search and they find out, say there's 5 partners, and 2 of the partners are basically broke, but 3 of the partners are heavily asseted, they could turn around and seek recovery from those partners. And once again, keep in mind that when you're formulating that partnership agreement, you want indemnification clauses, cross indemnification clauses, where if in the event one partner has to pay because, there's other partners, that are, say, judgment proof, that are assetless, that the partner that paid has a potential that they can execute a cause of action against the partners that were deemed by the defendant or the creditors to be judgment proof and assetless. But keep in mind, whether you're dealing with a partnership, and we're in terms of a general partnership, or a sole proprietorship, and for that matter, any other entity, there are, when we say, you don't have liability protections, um, that may very well be accurate in many, if not most, circumstances for business loans, credit from suppliers. That may be accurate. However, there are other potential liabilities that are insurable risks, and this is something that you have to basically sit down with, um, and find out what risks are you exposed to in your partnership, and try to insure for those risks. Quite obviously, one would be business interruption insurance. There would be workers' compensation insurance. There would be liability insurance. There would be fire insurance. There's a plethora of insurable risks that can limit your financial exposure. But nevertheless, when you are a partnership, especially a startup, um, the real reality is with that when it comes to debt financing, and utilization of credit by suppliers, you do have risk. There's no limit on that liability. There's no limit on that liability. Now, there are times where partnerships become so well established and they have a Dun and Bradstreet rating, and the business entity is 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 considerably asseted. Like, for example, maybe the partnership actually owns the building in which they're doing business, or buildings in which they're doing business, as in real estate. Um, Likewise, they may have a considerable volume of accounts receivable. And again, when you look at accounts receivable, they're not all equal. you know, Accounts receivable, notwithstanding what the terms are, 30 days, 60 days, 90 days, 100, you know, uh, are your accounts receivable paying? That's critical. Unfinished inventory, finished inventory. Many times suppliers, once you're significantly established, really don't look to the principals, the partners, to be on the risk, specifically for, say, like supply, credit for supply, because they trust that the partnership itself is asseted and will be able to pay the bills. And if it's not, at dissolution of the partnership, they will be able to get paid. But in the absence of, that business goodwill that's established, and that reputation that you have, not only with customers and clients, but with suppliers in the industry, um, you may limit your risk. But again, when it comes to startups, the real reality is is that there are no protections of liability, financial liability for debt financing, or supply credit. That's reality. One of the important things that businesses need to do is to establish a Dun& Bradstreet credit rating, which can be done sometimes within six months. I mean, you're still a startup, but it is something that need be addressed. If you're remiss on doing that, you may always be signing not just in the business's name, the partnership. You may be signing in your individual capacities. Another thing to be aware of, sometimes a partnership has, a particular name, doing business as. If you ever see DBA, doing business as. So they're publicly known as, say, Schwinn Bicycles. But let's say Schwinn Bicycles, and it's not, is a partnership. Well, the partners are still liable, notwithstanding the fact that they do business. That particular partnership does business as Schwinn Bicycles. So, looking at assets and accounts receivable and your reputation and goodwill can change the level of 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 liability. Um, you have LLCs. In some jurisdictions, they're limited liability companies. In other jurisdictions, they're limited liability corporations. The nomenclature is not really, all that dispositive. What is misleading at times is the fact that it's limited liability. Well, why do people, form LLCs? Well, supposedly to protect their personal assets. So they form this business. But here's one of the realities of a startup LLC, which is in many respects, not that much different than a partnership, is that unless and until you get a Dun & Bradstreet rating and you have a reputation within an industry for being established and asseted, you're going to be signing in your individual capacities. Why? Well, lenders, whether they're financial institutions, or their, personal friends, really do know that, the business is a startup, and there isn't any guarantee that the business will be successful and that there will be assets that will be salvageable if the business is unsuccessful. So what do? They when they're giving you a loan, they have you sign in the capacity of, the LLC, especially if it's doing business as, and then they have you sign in your own individual capacity so that your personal assets are at risk. Do LLCs reach a point? And again, it depends. If you're around long enough and you have an established Dun & Bradstreet, you have goodwill, you're at the entity, the LLC is sufficiently asseted. Many times you'll find, especially in business relationships, your suppliers don't require you to sign in your individual capacity. Because the reality is this, is that as a business, they basically know that you're not really going anywhere, or at least they don't think. But ultimately, if need be, if a supplier wants your personal assurances, that's something you need to contemplate. If you look at, say, formation of business forms, they're really an expedient to effectuate exchange. Um, so the quicker any business becomes establishes goodwill and becomes sufficiently asseted, the the easier it is for that entity to actually do business without the assumption of that individual risk. And then, of course, you have subchapter S's, which are pass throughs. The LLC is a pass through for tax purposes. Um, you're, the members of the LLC are taxed at their own individual rates. An informational return is is put together. But again, it's a pass through. And a lot of people don't realize this. Most businesses that exist, in the United States today are pass through entities that the corporate tax is not really applicable to. Then, of course, you have, the Chapter S corporations that, in many respects, is the way family businesses, not always, but many times, wind up doing business, especially if you have generational transference, meaning you have a grandfather, you have his sons, and then the grandsons of the grandfather, and you're limited to 100 shares. Um, if the business is sufficiently asseted, you usually will have suppliers not require individual assurances. A lot of times, when it comes to debt financing, financial institutions, they're a little bit more scrupulous in terms of having, aside from the business, someone signing in the capacity of a principal for the business. They're a little bit more scrupulous for the very simple reason you're usually dealing with a loan officer that really doesn't want to see a loan go into default that they basically put together, and the principal is maybe judgment proof, and they didn't have the personal assurances of other key shareholders. So, when you're dealing with debt financing, you've if it's a lending institution, more often than not, you're gonna have some personal liability. Um, when you look at these pass-through businesses, ranging from sole proprietorship right on up to a subchapter S corporation. And again, remember, the limitation is that no more than 100 shares, and it's not publicly held, and it's not publicly traded. It's a purely private entity. That all of these businesses always have the option of getting debt financing from friends and relatives. And depending upon the sophistication of the friends and the relatives, you know, you may have different arrangements in terms of personal assurances versus an assurance from the business entity itself. So debt financing for these entities basically comes in two forms. Either they go through a bank or a lending institution, which is formal, or it's friends and relatives and is not formal. Excluding a sole proprietorship, the other ways of financing is equity financing. So let's say we have, a partnership of 5 partners. They may be very interested in taking on a 6th partner. Why? That 6th partner is going to bring equity to the firm. It may be in the form of money. Many, if not most times, it is. Sometimes it's in the form of capital plant, business machinery, or some type of productive machinery, or real estate. Outside, if you're looking at a sole proprietor, the sole proprietor, of course, can have equity financing in terms of they themselves bringing equity to the business. If, however, the sole proprietor is looking to someone else for the purposes of equity financing, not debt financing. Debt financing, they can borrow from whoever they want to borrow. But once you invite somebody to bring equity, to bring capital, financial capital, to the business, it's no longer sole proprietorship. It becomes a partnership, and it would behoove both parties to seek counsel, legal counsel, and accountancy counsel in putting together a partnership agreement. Likewise, with an LLC, they can take on another member. Now, some states, depending upon the state, sometimes will have limits on the number of members or principals. The nomenclature varies from state to state. That you can have in the LLC. But again, you can bring equity. If you're a subchapter S corporation, you can bring on a nephew, and they bring equity to the entity, and then they're given shares. And when I say equity, again, many, if not most of the time, we're talking dollars, as in the meeting, as a medium of exchange. That's the equity that they're bringing. But don't be surprised at bringing real estate. Don't be surprised at situations where people bring capital plant. And don't be surprised at situations where sometimes people actually bring expertise that is key to the business. And that's the equity. That, like, for example, let's say you have a firm. just say you have a firm that makes supplements. Now, it could be an LLC, it could be a partnership. And you know somebody that's a dairy chemist. Now, a dairy chemist to a supplement firm is a very valuable asset. So that dairy chemist may very well bring expertise to the firm in in the form of what he and the firm views as equity. And sometimes that can get very complicated, especially if there's disagreements later on. But when you look at equity financing, it's not always in the form of money, not always in the form of money. Likewise with businesses, you can always utilize retained earnings as a form of financing and growing the business. You find that a lot of times with startup businesses, the principal or the principals that are involved sometimes don't take a salary for a year and a half. And, those profits are just, instead of, paying salaries, they're just put back into the business as financial capital to grow the business, or to at least create greater solvency within the business entity. So when you look at the forms of financing, I mean the most obvious and the least complicated is retained earnings. You can have debt financing from formal lending institutions, or you can have debt financing from friends and relatives, which is probably informal as opposed to formal, unless you're dealing with somebody that has a lot of business acumen, and knows their way around. Equity financing, again, partnerships, you can take on a general partner, you can take on a limited partnership. An LLC, you can take on, another member, another principal. Subchapter S, as long as, you're not going above the 100 shares, you can you can obtain equity financing that way. Now, there's another way of financing outside of retained earnings, debt financing, and um, equity financing. And again, I'm just talking right now about sole proprietorships, partnerships, limited and general, LLCs, and subchapter S's. Subchapter C's is another topic that will follow this discussion here. Um, any business can always seek a leveraged buyout, and basically, you know, you can do it, as a corporate entity, seeking to acquire another entity of any form, Or you could be, you could be a sole proprietor that, is looking at a target business that's for sale and wants, doesn't have enough financial capital, and they also not want to put a lot of their personal assets at risk, um, can look for a leveraged buyout. But remember one thing about a leveraged buyout: whether it's between a lending institution and a corporate entity buying another, acquiring another corporate entity, or whether it's an individual that is looking to buy a particular business, the target business entity, regardless of its form, when I say target business entity, has to be very well asseted and established in order for a lending institution to get involved in a leveraged buyout. Because in essence, what happens in a leveraged buyout is that the assets of the target business are collateralization for the loan. So, you're talking about, if you've got a business that's for sale, there's a business that's for sale, and you're interested in purchasing that business, and you don't have a whole lot of financial capital yourself, and you may have some reservations in terms of the extent that you would want to put your personal assets at risk. One way, although the strictures are rather are rather tight, one way of financing would of course be a leveraged buyout. What you would do is you would look at the target business. You would be in touch with it's kind of like forensic accounting. There's firms that do business valuations, and they basically will go and they will look, they will look at the financial statements, they will look at the balance sheets, they'll look at cash flow. What are the assets that are owned by the business? What do their accounts receivable look like? I mean, if you have a lot of accounts receivable that are delinquent and in collection, that's I'm not saying that's a deal killer, but you know, um, that's not something that makes the business all that attractive. Accounts receivable, well-established customers or clients that regardless of their terms of pay, um, they would look at that. Um, and of course, the business would be the collateral. And what would happen if the purchasers, the borrowers, purchasers of the business, the borrowers from the lending institution, for whatever reason, default on payment? What the bank would do more often than not, given the business's success, would basically appoint an interim trustee that would run the business and ultimately look to resell it again, because the business is so sufficiently asseted, it itself becomes collateral. So Leveraged buyouts are not always doable, but they can be. So again, remember, retained earnings, debt financing, equity financing, and leveraged buyouts. When it comes to equity financing, sole proprietorships, forget about it. When you're equity financing as a sole proprietorship, you're really becoming a partnership. All of the rest of the entities, partnerships, LLCs, and subchapter S's can take on other principals or other partners and receive equity that way, meaning they bring money to the table and they become part. They have an ownership interest in the firm. Another form that I should mention is the joint venture. Now, a joint venture could be done um, between two sole proprietors because a joint venture, while it in many respects has the trappings of a partnership, it's for a limited purpose or for a limited time. Now, for that limited purpose and for that limited time, the agreement of the joint venture may very well mirror what the articles of partnership would look like in many partnerships, or again the partnership agreement. But what's key is that the joint venture is entered into between any business entity. It could actually even be two subchapter C corporations that can enter into a joint venture, but it's for a limited purpose and or a limited time. And it's usually both. It's usually both. And then at that point, there's dissolution, and the entities that are involved basically uh, function on their own without any entanglements from the other with the other entity. You see this a lot of times with American businesses that do business in China. They have to partner with a Chinese business within that same industry. Sometimes it goes to the extent of actually being a partnership. Sometimes it only goes to the extent of being a joint venture. But remember, joint ventures have a very specific and limited purpose, and for a specific and limited amount of time. Um, Subchapter C's. This is a different animal when it comes to business formation. Now, obviously, um, there is truly a limited liability when it comes to ownership in a subchapter C corporation. If you and I go out and we buy shares of stock in a corporation, only what's at risk is what we paid for those shares. Now, those shares may actually increase in value over a period of time. And if something happens, with the dissolution of the subchapter C, the bondholders are going to get paid, but the shareholders, depending upon whether you've got common stock or preferred stock, you may or may not get paid, and you may not get paid at full value. But in essence, it's really, when we talk about limited liability, if I take $10,000 and invest it in a company, and there's the company is unsuccessful, it's dissolved. All I lost was $10,000 because that's what I paid for the stock. Another way of looking at it is I paid $10,000 for the stock 10 years ago, and that stock now is worth $100,000. The reality being is, I would feel that I lost the 100,000. But again, whether you view, the loss, the limitation of liability as to being the initial principal investment, or you look at the maturation of a stock over a period of time increasing in value, it's nevertheless limited. It's not like you have like a partnership and you have joint and several liability, and you've got your partners are basically judgment proof, and then you turn around and you get hit, and they're basically garnishing your bank account, and seizing your car, your boat. It could be a catastrophe. So with a subchapter C corporation, when you buy stock, you most certainly do have a limited liability in terms of your investment. Remember the predecessor of the modern subchapter C corporation today was the joint stock company in Europe. You know, Trade between North, Central, and South America and Europe really began to flourish. And one of the ways entrepreneurs could generate the financing for getting in the shipping business, um, is the joint stock company. You could say, in many they would sell stock, and of course there would be limited liability. Whatever the shareholders invested, um, their liability would be limited to their investment. However, the potential to raise revenue, I wouldn't say it's infinite, but it would be close to infinite. Meaning, you could sell as many shares of stock and buy as many ships that you want, assuming, of course, that you had a reputation for being successful in these ventures back and forth across the Atlantic. Maritime insurance was also, something that arose then because of the joint stock companies. Many times you lose a ship and you lose cargo. So insurance became, an important concept at that time. So today, yes, the modern subchapter C corporation, it's publicly held, it's publicly traded, and when you buy shares, your liability is limited. Now, in terms of financing, a subchapter C corporation has the advantage of offering bonds. Now, if you look at debt financing, a subchapter C corporation could go to any lending institution and effectuate a loan. When it comes to debt financing, the subchapter C corporation would also have the option of offering bonds. Now, the relationship of the corporation and the bond purchaser is that the bond purchaser would be the lender, and the corporation, the subchapter C, would be the borrower. There would be a maturation date, and there would be, a designated interest paid, denoted as coupon payments over the period of time. At the maturation date, the principal would be paid back to the lender, and any fraction of coupon payment interest would also be paid in. During the life of the loan, that's what it is, the bond, there would be periodic payments of interest to the lender, designated as coupon payments. Now, there's bond rating agencies. There's Fitch, there's Standard & Poor's, there's Moody's, and they would rate the bonds in terms of risk. Very low risk bonds pay a less attractive coupon payment interest rate because the risk is less. Risky bonds, because there is that risk, pay a higher rate of interest. But whatever it may be, I mean, this is, we're not really looking at bond markets right now. Issuing of bonds by a subchapter C corporation is really just another form of debt financing. That's really what it is. Rather than dealing with a singular lender, they have multiple lenders. That's their debt financing. In terms of equity financing, when a corporation, or not, I shouldn't even say a corporation, any form of business decides to go public, and they become, a publicly held and publicly traded subchapter C corporation, they basically go to an investment bank, and that investment bank basically puts together the deal, because it's very, very regulated between the Securities and Exchange Commission. There's FTC involvement. You really need the investment bank's expertise in putting that deal together. But suddenly, what's created is a subchapter C corporation that's going to have an IPO, at an initial public offering. At that initial public offering, those shares of stock that are purchased is direct equity financing of the subchapter C that just was created and had the initial public offering. That's the primary stock market when you're buying shares at an initial public offering. What many, if not most people, are more familiar with is the secondary market, where those shares are bought and sold over and over again. That's not necessarily synonymous with equity financing, because what's happening, the secondary stock market just serves as an inducement for the success of the initial public offering. So I go to, at an initial public offering, I buy stock. Now, for whatever reason, it could be just that I need liquidity, or it could it could be that I am not really impressed with the performance of the corporation in which I purchased stock. I then can sell them in the secondary market and get out of the deal. So the secondary market is an inducement. It makes equity financing of subchapter C corporations very doable, in that you're not really tying your money up ad infinitum for, forever. You can always sell in the secondary market. If you didn't have the secondary market, it's there could be a reluctance. It's like, people that invest in real estate. Some real estate investment is very, very lucrative, very successful. But one of the problems is that you don't have, a high level of liquidity. And in order to, create liquidity, you have to do one of two things. Either you have to sell the real estate, and that, depending upon what the real estate market is, could actually be 2, 3, 4 months down the line. The other alternative is to take a second mortgage, depending upon how much equity you have in the real estate that you're getting the second mortgage for. And again, then you're paying the cost of that loan, interest rate on that loan. When it comes to subchapter C corporations at IPOs, that type of situation is never a problem. You'll always be able to get out of the deal and create liquidity. I'm not saying that it's impossible to lose money. It's just that you can limit your loss because you can get out pretty much instantaneously in that secondary market. Now, another option for a subchapter C corporation is to initiate additional shares of stock. And that is another way of debt. Of equity financing. That can be done, and it is done. Sometimes when it's done, it's done to avoid a hostile takeover. Actually, what basically, happens is that there's a shareholder or group of shareholders that are acting in concert, and they're seeking a majority share of stock. Now, one way of diluting their ability to acquire a majority share of stock is to issue additional stock. Yeah, you may be thwarting a takeover, a hostile takeover, but you're also raising additional equity financing. So corporations, you know, have the luxury of traditional debt financing with lending institutions and traditional the issuance of bonds in the bond market in terms of debt financing. And they also have substantial ability for equity financing at the IPO, and then secondarily, you know, issuing more shares of stock, for regardless of whatever the reasoning may be. When it comes to taxation, the argument. There are people that really do believe that corporations pay the corporate stock, the corporate tax, just like we pay our tax. The difference between us and a corporation is this. Subchapter C corporations, more often than not, and I mean really more often than not, are highly departmentalized. That level of departmentalization gives the entity, the business entity, the corporation, the C corporation, a lot of expertise. Can a C project labor costs for the next year? Not to absolute certainty, but to a reasonable degree of certainty. Yes. Can they project the cost of, say, factors of production or delivering a service outside of some type of positive or negative demand or supply shock? Yes, they can. Well, if you can engage in all of those different predictions of cost, you can also engage in the prediction of cost in terms of what your tax liability will be for that year. And if you do have that projection, depending upon the elasticity of demand for your product or services and the price sensitivity or lack of price sensitivity of your customer and client base, you may be able to shift and spread to your customer or client base. Now, if you can't shift to your customer or client base the entire amount, or maybe nothing at all, you would always look to your workforce as a way of shifting those tax costs, meaning, you would be looking to keep labor expenditures down. You might look to automation so as to avoid having to pay benefits. There's different ways a C could effectuate the savings in a labor environment. But let's just say hypothetically, you have a subchapter C corporation, and you know the corporate tax rate just say went up hypothetically. And what they want to do is that they're going to investigate, the potential of rolling, shifting, and spreading that additional tax cost into the price of their product or service. But let's just say they find out that, well, a good portion of their customer client base is highly price sensitive. And not only are they highly price sensitive, there is a high elasticity for the demand of it's highly elastic. People can take it, people can leave it. Price goes up, quantity demanded goes down. So maybe that high level of departmentalization says we can't shift and spread to our customer base. Then they look to their workforce, and lo and behold, their workforce, they just entered into a 3-year collective bargaining agreement. So for the next 36 months, they're wed to this particular collective bargaining agreement. So they don't have the ability to basically, cut benefits or do any of those nifty little things. What's the alternative? The alternative is that they may look at a tax inversion, meaning changing the situs, the jurisdictional situs of the corporation. One of the attractive jurisdictions for corporations to flee to is Ireland. Ireland has a corporate tax of, I think, 13 or 14%. That is always an option. Now, years ago, tax inversions were relatively easy to perfect. It's a little bit more, I shouldn't say a little bit, it's a lot more difficult today, but not totally impossible. And that would be an option for when a corporation is backed up against the wall. So there's two schools of thought when it comes to the corporate tax. One school of thought is that, yes, corporations pay a corporate income tax on profits. And as a consequence of paying that corporate income tax on profits, they are subject to double taxation, which is not really double taxation of the corporation. The corporation is taxed on its profits. And then when it pays dividends, depending upon how the dividends are handled, those same monies are taxed again. Or when the CEOs are paid their salary or they're paid bonuses, those monies are taxed again at the individual rates of the CEOs. Or for that matter, any of the employees of the corporation. The house mouse that receives, an hourly wage and, makes $25,000 a year, if they're assuming at that $25,000 that they would actually have a federal income tax liability. If they did, that money is taxed again at the individual rate of the house mouse. So, you got to make up your mind what you think and why. I mean, personally, I kind of lean towards corporations use that high level of departmentalization, meaning legal expertise, accountancy expertise, to reduce tax liability and find ways of shifting and spreading, whether it be to the customer base in terms of higher prices or to the workforce in the terms of less favorable packages. And of course, if neither can be perfected, you always have the ability of at least contemplating a tax inversion. That may or may not be doable. But if a particular corporation can't shift and spread its tax liability to customers or to workers, it most surely did try. It it again, different industries have different levels of price sensitivity and demand elasticity that make shifting and spreading either easier or more difficult. So they certainly try. Keep an open mind about that subject, and do some reading and on your own, and more or less make up your own mind whether or not corporations pay the corporate tax, or do the general public pay in higher prices and workers pay in lower wages and less favorable benefit packages. Highly controversial, highly controversial, you know, but you need to investigate that, because you're going out into a world in which, federal corporate taxation is a hot topic of the day. Well, I will cease part one. This is part one of the lecture, and I'll give you the code. The code word for part one is TOPS. TOPPS. Again, I'll repeat that. The code word, the attendance code word for part one of this lecture is TOPS. TOPPS. Take a break, and I will see you shortly for part two.